And hopefully the answer is, wow, I like to use it.
Yeah.
I want to use the solution, because that's the whole idea why you made the investment.
That's funny because a whole lot of people listening or watching right now just went, oh God, if we only could get our people to say, I want to use that solution.
Right. and that goes back to my
Well, welcome to the ERM Advantage podcast. I'm Eric Holmquist, and today in studio, we're very lucky to have a longtime friend and colleague today, Allan Cuttle. Allan is a deep expert in the field of risk management and particularly in GRC software solutions to be able to automate risk and compliance. So we're going to be talking about a range of topics today around some direction, trends, and kind of best practices in risk and GRC. So welcome, Allan.
Yeah, appreciate it, Eric. Looking forward to it as well. You and I have known each other for years, and looking forward to the discussion on this topic. You know how enthusiastic I am about it. So looking forward to it. And again, thank you for having me.
My pleasure. All right, so let's talk kind of general. We're gonna cover kind of risk management because, again, we've been dancing in the space for a long time, and we've seen the good and the bad, the ugly of risk management programs and practices. And at some point, we hope we learn from all this. But let's start broadly. We do a lot of work and had done a lot of work around financial services. So, I know in your background, you've worked for a variety of banks, all the way from big money center banks, and as well as advised a lot of banks as well. So, maybe you could just kind of chat a little bit about some of your thoughts on the industry and banking in general, and kind of where it's at and, where you see it going right now.
Yeah, sure. It's just fascinating right now where banking is. I mean, I think we're at a crossroads right now. If I look at where we were when I started back 30 years ago and today, a lot of different dynamics coming into play today. I think you're seeing technology advancements in AI and a lot of things that are affecting that market as well. We're seeing a lot of companies today, especially on the technology side, with legacy solutions, legacy infrastructure, and we've got a lot of, compare that to a lot of innovation that's coming down the line. I think there's a lot of challenges for the banks to stay up to speed, upgrade their tech stack. So I think technology is playing a big role in the next step for these banks and where they have to go.
Well, and let's explore that a bit, because obviously, banking is banking. And at the end of the day, it's about, checking and savings and loans and all of that. But as you said, we're seeing a lot of evolution in technology, and notably with things like AI. So, maybe just chat a little bit about, from your perspective, how do you see AI impacting banking? I mean, it's good and bad, but what are you seeing?
I think the first thing that comes to mind is the customer experience. I think that hopefully it'll enhance the customer experience from a lot of different perspectives. I'm also seeing AI from an operational efficiency perspective in organizations. Looking at back office roles and what they do there, I think there's a lot of efficiencies to be gained with AI. And people worry about what happens to my job because AI is going to take it over. I still think you need the people on the ground to do the work. I think it's going to let people work smarter, not harder. And I think that's going to be a big efficiency for them as well. The other thing I say too is your customer experience overall for clients using new websites and using all the different types of interactive bots or whatever they need to do to look at their accounts, to have an experience on the website, to go after new loans and everything. AI will play a role in that as well. And the other thing I say is risk management. I think it's going to really affect our discussion today. Is AI is going to take that to the next level. It's really going to enable us to be, and we'll talk about this a little bit later, more predictive in how we manage risk in organizations, how we manage compliance.
Yeah.
And I think that's going to play a role as well.
And I agree. And like I said, this is a great big bucket of good news, bad news.
Yes.
It seems to be there's thoughts around how it can business enable, as you said, it could open up opportunities for new products, services, delivery methods. Yeah. But the bad guys get to use the tools too.
Right.
And so, we're certainly looking at a lot of areas like financial crime and things like that. And setting aside, the tech stuff and all of that, just, back broadly to the industry in general.
Yep.
What from where you sit and with clients you're working with, you see as some of the bigger threats, to banks in the coming years?
Yeah, I think in addition to financial crimes, you got fintechs. and that's a big thing because a different way of banking, open banking, fintechs, and I think it's gonna offer a new challenge for these institutions because there's going to be more competitive landscape for them to deal with as well. So you've got financial crimes, you've got the fintechs, you've got outdated technology stacks that need to be taken care for. That has to be fixed in order to deal with the new environments that we're living in. So I think that's some of the threats, that's some of the headwinds they're going to face, and the ever-changing regulatory environment. I think that is huge because one of the things there is that the regulatory environment is changing because of the new administration. They're pulling back a lot of regulations, but we can't get complacent because that could change, and we need to have the ability to move forward again and deal with the regulations that are in place. But I think along with those headwinds, I think there's some benefits to some of that because it will take away some of the regulation for some of the smaller banks that get hamstrung sometimes. And the interesting part about that too, in terms of regulation, is staying on top of the changes.
Mm-hmm.
The changes happen all the time, and smaller banks have to mine that data themselves. Thus, AI comes into play. So you've got those headwinds. So AI can actually help them, but they have to do that and stay on top of that in order to maintain good compliance and also be not only just for compliance for their organizations, but the regulators will be walking in and they want to make sure that they're up to speed on the latest and greatest regulations that are hitting the street.
I absolutely agree. Now, you hit on a really good point that's worth drilling in. You talk about fintechs. And, this is something, we've kicked around this for years. And as we look at, fintech companies entering the marketplace, they divide into one of two buckets. There's, fintechs that, want to work with banks and bring better, faster, cheaper, and as a partner with a bank. And then fintechs that want to be banks and are actually competing against banks. This, I think, is still on an evolutionary curve. And, depending on who you talk to, the as a strategic partner is good. I mean, I think there are certainly ways that a fintech could do better, faster, cheaper, and it makes sense. It makes more sense to partner with somebody than try and do it yourself. But in terms of, the fintechs that are looking to disintermediate banks, depending on who you talk to, you get everything from, banks are done, there'll be no more, all the way to, we've seen them come and go. What's your take? I mean, is this a true existential threat to banks, or will there always be a role for a typical bank?
Yeah, I think there'll always be a role for a typical bank. I don't think that they're going to go away. Will they scale back brick and mortar? Absolutely. Will they have to increase the digitalization of their frameworks and offer it to different generations who want different things? It's also going to depend on the market. Different customers want different things. You have the older generation that's going to want more of the brick and mortar and go into those banks. You have some of the younger generation that may never step their foot into a bank.
Yeah.
But I think you need the bank in a sense. What that looks like in 10 to 20 years, I'm not sure, but I think there will be banks, and the fintechs are going to have to live alongside of them because it takes a bank's footprint and pushes it across the nation, over 50 states. That's a big thing because you can go online and get loans through Upstart and Upgrade and Best Egg, and you can be sitting in California or Denver, and that bank that's going to give that loans in New Jersey. So it's going to offer people a lot more choices in the market. So I think they're going to have to learn to get along. And what I'm seeing as well is the regulators are looking at this and saying, hey, we have to hold the fintechs to the same level playing field that the banks are under as well.
Yeah, and I completely agree. I do think that they'll always be a part of the ecosystem. I don't see fintechs displacing banking because I think you need institutions, one, that are properly supervised, and two, that really there's a trust element there.
Right.
And banks, are certainly chartered with the intention of serving the customers,
Right.
So providing financial services. And, could that be completely displaced by a fintech? I just don't see it happening.
Right.
I think we'll continue to see an evolution in what that combination looks like.
Right.
But I think as a partnership. Now, in all fairness, we should go down one quick road too, and then we'll move on to risk management. We got to talk about digital for a second. And, and again, we could spend all afternoon talking about this. But I think it's just worth a quick impression. So I really like, and I've mentioned this before, I like the approach that I think Congress is taking in that embracing the idea of stable coins, because now you're embracing the technology effectively. And I think there's a strong recognition that, look, blockchain is here to stay, okay? And I think there's a number of use cases that are very interesting, worth exploring around how a blockchain could be used. Whether it's the coins, I think that's a whole separate argument. So that I think makes sense. I think the approach of exploring crypto, native crypto, and saying, okay, that's fine. And I like the fact that they're saying absolute no to a central bank digital currency, which I've written on this before, would be a phenomenally bad idea. So all of that to say, I think if we look forward in the coming years, we're going to have a banking ecosystem that has some element of a digital rail, if it's just a stable coin, which offers, again, some new use cases around that, but new risk. So any perspective on how you see digital impacting banking, is this revolutionary, or is this just, one new little tool in the tool bag?
Well, I think it's a positive. I think it's a positive for the market, people who want to deal with digital currency. I don't think that it's going to be for everybody. Not everybody understands blockchain.
Yep.
Not everybody gets this whole new stable coin concept.
Yeah.
So I think there's a level of maturity and a level of intelligence that needs to go into that and experience with that type of currency in order to get people to buy into it. So I think you're going to have people who are going to be forward thinking, and they're going to want to get into that market. Myself, I'm not in that market.
Yep.
So, and I don't think I'll be in that market anytime soon. But when I read the papers about how much money some people are making on some of these memes and some of these coins, it looks very enticing. I just don't know enough about the exchange really to understand the nuances and to be a conscious and conscientious investor within the space.
Well, again, I think we have to separate the two elements. You've got the coins, and that's where more of the kind of investment part comes from, and that's a buyer beware kind of thing. And I'm not so focused on the actual coin itself, really more just the transaction rail, being able to post transactions to a blockchain, not just monetary transactions, but you can record other things like titles and things like that. My sense is this is fighting gravity, that it's going to be here. I haven't quite worked out in my mind all the different risk nuances.
Right.
I think the only thing that I know is it is here to stay. We just got to figure out what the use case is.
Right.
Because I think it does disrupt some things. I mean, something as simple as, right now, banking is the dollar.
Right.
Outside of FX, foreign exchange. Right. So we know it's the dollar. We know it's going to be managed through, a servicing system, and a lot of very familiar, to go through the Fed. All those are very familiar elements. And that's not going anywhere anytime soon. But that has its own limitations. Fraud is an issue, time delay is an issue, things like that. As opposed to a blockchain, it's real-time, immutable transactions. So it's almost like it solves one problem, but it kind of creates another. Now, there's real questions about, whether our Fed is really prepared to manage an environment with a blockchain element, but let's just hold off on that for now. So let's talk about risk management, because this is an area that, I know you're a deep expert in and work with a lot of clients and have helped a lot of institutions with their programs. We'll spend a lot of time talking about, software solutions, but I want to cover some of the foundational elements first, because, I'll offer an observation. From what I've seen at this point where we are now, I think literally, just about every institution has built something that they would call their enterprise risk management program of varying degrees. But a lot of what I've seen is programs that, I don't want to say they're wrong, but I think there's some foundational elements that maybe were not strong. And oftentimes built around kind of an audit mindset. It's about controls and processes. And look, a lot of the really break the back risks aren't necessarily process. So consequently, because a lot of them tend to be very grounded in more of the operational risks, what's the process, what could go wrong, what are the controls? The program is not really meeting its expectations. So it's not really creating value. Would you agree?
I would agree. I think it depends on different organizations, but a lot of the programs I see do not really add value to they're going through the motions of doing risk assessments, monitoring metrics, doing some reporting, but it's not really getting the crux of what risk management really is, and that's the ability to help management make better business decisions.
Yeah, I mean, outside of my observation of too operationally focused. What other sort of flaws do you see in approaches to enterprise and operational risk?
Well, big one, all siloed. You have a lot of different silos in organizations,
Yep.
and they're not talking to each other. So you've got second line working in their domain, you got first line working in theirs, and there's no collaboration between the two. So we have silos that are problematic. We also have risk isn't tied to strategy. So there's nothing, that risk is not even at the table in some of the strategic meetings they have, or is compliance, because if you look at risk management and you look at compliance risk, that's sort of the same thing. And you also have, has anybody done any work on risk appetite? They have done nothing on risk appetite. Maybe a little bit on risk assessments. Some of them are just thrown over the wall to say, hey, assess these risks as the quarter end, and we need to do this. It's more programmatic. It's not embedded in the business cycle. And risk management embedded in the business cycle, that's where you're going to create the culture for the organization. And that becomes something that can transcend time. And then as we spoke about earlier, banks are changing these days. We have AI coming in, technology, more digital focus. We've got different hackers, different fraudsters coming in. So we got to manage those risks. And in order to manage those risks, you need to have a solid risk management culture. So those are some of the things I'm seeing. And also people don't, from the governance perspective and the accountability perspective, not everybody knows their role in risk management in the organization. If you ask somebody who owns the risk, and a lot of times they'll still get the answer second line, when we
Yep.
both know from experience that it's embedded in the first line. They own the risk, they own the controls, but yet people don't know their role in an overall program. So I think there's a dimension of training and understanding what their role is. That's flawed a little bit. So these companies need a little bit more training on what ERM is, sort of a ERM 101.
Yeah, I completely agree. And I know, I know you're well aware of the videos I have on my channel, and thematically as right down the middle of kind of what I've been talking about. And the culture one is huge.
Yeah.
Um,
That's
you
a
know,
tough one.
risk management lives and dies on culture.
Right.
And
100%.
if you've got a culture where people are afraid to speak up, if they're punished for speaking their minds, to your point, if they don't understand their roles, you're kind of dead before you start.
Right, right. And it's not about the 200-page policy to manage risk. Anybody can build that. It's about going out and asking the right questions. And it's about, and CROs today, I think, have a huge role to play here in that program, because it's not just about creating a policy and then a program document around it. It's about sitting with folks to understand what could go wrong, what keeps them up at night, and also asking the right questions, whether it's the business line or even at the board level. Because I think a big thing happens today is they get in there and you and I have talked about this in the past. The chief risk officer is not the chief no officer. It's another way to look at a business concept or strategy to understand the risks and understand where you can modify that strategy a little bit more so you actually can take more risk. It's not about taking less risk. It's about taking some more risk and being protected and getting that additional return that you need. And that's what people don't see. Some people see risk management, as you called it earlier on, you say, as another concept of audit.
Yeah.
And it's not audit. It's more of a way to enhance business, to make more money, to make better business decisions, to run faster. But the risk management offers the brakes on the wheels if you need to pull back a little bit from time to time, where you're running into some headwinds that could get the bank into trouble.
And then flipping the script. You've worked with a lot of clients. Have you observed, elements of a program or characteristics that you thought were really mature or really worked well, for programs that were creating value for the organization?
Yeah, I have. I mean, I think that's embedded in that is banks that have good risk appetite statements,
Yep.
where they're sitting down with the C-suite to understand what's our risk appetite, and not just throwing some words on a piece of paper, really sitting down and understand our risks, how they're structured, and how that organization thinks about risk management. That's a key thing. It's not about looking at the OCC 8 or the NCUA 7. How do we think about risk in our organization? How should we manage it? You can always map that data back into those regulatory accepted frameworks, but it's how do we manage it here? So starting off with a really good risk appetite statement, because then that gets also that gets the risk management team a seat at the table. Hopefully gets a seat at the table, because the value the CEO sees is the value of risk management. So having that CRO or CCO at the strategy table, that's a good sign, because now they're offering up their insights into the strategic direction of the bank, both from an operational perspective and a technology perspective. And then looking back and saying, okay, how do we manage this going forward? It's a concept of having some really good risk assessments, but not ones that are just going through the motions. Ones where we're stepping back a little bit. We're saying, what are our key processes to our business areas? What are the key risks to those business processes? Not sort of the cuts and scrapes as we talk about all the time, the ones that are impactful that can hurt the organization. And what are those key controls? We don't need 1,000. What are the key controls that are going to help us mitigate that, or other mitigants we may have that are going to help us mitigate that risk and get us to a residual value that we could live with? The other side of that too is communication. I think good risk management houses that I've seen have really good communication between first and second line, because they're offering that credible challenge. And when I see first line of defense actually call second line and say, I need help with this, that shows me that they're not an impediment. They want to have them succeed, and there's a combination. Now, if we look at what's nirvana, it would be the combination of first, second, and third line working together. So when the audit department comes in, they're aware of things that are happening as well, and they're actually giving credit to the first line of defense for things that they've done well.
Yep.
And not getting a sort of I got you moment where I'm getting you on an audit point.
Right.
It's giving them credit for things they've done well.
Yep.
And then lastly is training. A good training program where we're consistently training our folks on what good risk management looks like. What does good look like? And what does it? It's from just a programmatic going through the motions exercise to something that's going to really add culture and add credence to the everyday business cycle, because that's the key. Risk management living and breathing on a desktop, and it's changing as the organization changes as well.
Yeah, that you're so spot on the risk appetite point. And I've seen a number of institutions where they have a general sense of what their appetite is, but they don't necessarily want to put it on paper. Right. And that could mean several things. It could mean they want to take a bunch of risk, but they don't actually want to write that down. And I think your point is an element of maturity is having the integrity to write it down. Right. And say, we're intentionally taking risk in some areas. Right. And that can be seen as something scary. Oh my God, you can't say that out loud. Well, you can. Right. You can. I think there's also an element of a kind of accountability that you can't have a risk appetite statement that says, oh, we're super conservative, and that your strategy is we're going to conquer the world. Right. There has to be, and you've heard me say God a billion times that the key guardrails of strategy and risk appetite, there has to be consistency between them. Yep, and those have to agree. And I've seen many times where the process even of developing a good, thorough risk appetite statement and metrics really kind of, I want to say forces, but it's a good exercise in being able to make sure we have agreement and we have a clear story. Yeah. And then, as you said, the ability to assess risk, to accept the fact we're not going for no risk. Yeah. We're going for the right risks. Right. And then, you mentioned assessing things like your process as well. But in my experience, I think a lot of institutions, they sort of figured out the process part because, again, audit's been on this forever, so they're familiar with that. But less comfortable at more of that, what I call the macro risk, the risk of my strategy, and some of the more high-level design elements of the bank, as well as some of the external influences. Have you seen a little more effort around intentionality around assessing those kind of risks and being kind of honest about assessing them?
To be honest, I don't see that quite often, and that needs to happen.
That's disappointing.
That shift needs to happen, and you're right, because we don't look at how things are designed. Because inherently, if they're not designed properly, they're not working properly. If you look at the assessment of control effectiveness, what are they folks first you look at? You look at control design, and then you look at the performance, and that gives you an effectiveness rating. So the answer is no on that point. The other point I would say to you, I think banks are too focused on these categorization schemes, where we've always have bucketed these things in the basic categories of, give me an operational risk, and what's my operational risk profile for the organization? Yes. But when you look at some of those operational risks that are in those buckets, they have impacts to other risks that are in there. And the programs today don't really include those impacts in those other risk buckets. And I think we're missing something from that. So I'm always seeing the same thing. While we're getting risk appetite better, we're getting the culture built better. We're still staying in that line of those categories.
Yeah.
And to get a shift in that would be somewhat be somewhat dynamic in the market.
Well, you're well aware that I've been rampaging about this for some
I know
time
you have.
now, and it is central to the ERM Advantage framework that we have to get away from using risk types as primary dimensions.
Exactly.
We want to use them as lenses.
Right.
Very important.
Yeah.
I need to conclude what my credit risk is.
Yeah.
But if we try and shove everything into those buckets, building programs that were aligned to those dimensions, it was never a good idea.
Right.
And I think part of what I've encouraged, and I think you have as well, is try and get back to the more simpler, what's the thing that could go wrong? Let's
100%.
ask that question first.
Right.
Whether it's a bad design, whether it's an external influence, whether it's a process failure, then we can consider risk types, as part of the impact.
Right.
You also work with a lot of CROs,
Mm-hmm.
and you've been in risk groups, but I think this is a role that is evolving, and I think a lot of people are put into this role and don't necessarily understand what it is,
Mm-hmm.
and work toward that. But you've worked with many, so what do you think makes a really effective chief risk officer?
I guess there's a couple of things. One is it's a strategic thinker. I think you have to have somebody that understands the business of banking. That's going to be the key, because he has to understand the risks that are there, and he has to come in. And again, I said it before about not just creating a policy and a framework right away. It's asking the right questions, getting in with the people so he understands, why are we managing risk in the organization? What's important to us as an organization? A lot of times, some CROs do that, and some CROs don't. They take a different tack, which is fine. Everybody has their own approach. But from some of the attributes of a good CRO, I think, are the ones that ask the questions: what's wrong? How could we be doing this better? What keeps you up at night? And start to understand how the business units think of risk in their organization. I think in order to be a good CRO, you have to understand how people are thinking about risk in the organization to affect change. Come along with that comes a good communicator. You have to be a very good communicator to communicate some of these things to folks. You also have to bring an element of helping people understand their roles in the process. So of a trainer, what is the role of first line? What is the role of second line? How do we interact with third line of defense? And I think that's something that also has to be in play. And then down to the framework elements to try to look at whether it's a brand new a program for a smaller bank that's just trying to get into ERM, or one where somebody comes in and says, how do we make this more proactive than reactive? Because if you look at the history of risk management, a lot of it's been reactive in the past. Things happened. Yeah. How do we fix it? You and I have had this conversation for a long time about KRIs. All of them are lagging, some are predictive than others. So how do we get people to start to think about proactive risk management versus reactive? And putting things in place where you can look, whether that's dashboards, whether that's looking at indicators in a different fashion. And I think all of that makes the elements of a good chief risk officer. And also working with the boards. I think that's key. And it's something you said earlier about risk appetite that I wanted to say, and we jumped to the subject, was working to identify risk appetite in the organization, but also working with the boards to see what is their feeling about the risk appetites of the organization, how much risk the board is willing to take.
I agree.
And then also at first line, where do those strategic risks manifest themselves? Always in the business line. They're always going to come back to the operational processes that are going to manifest themselves there, except for strategic execution. I get that. But so I think he has to get together with the board, and he also has to work with the business lines as well. So those are some of the attributes I think of a good CRO.
And I like the two things I hear there that I really resonates with me is certainly a subject matter expert.
Right.
It's not a job I think you can come in and learn on the job. And I've seen that. I've seen people that, well, he's a smart guy, so we'll bring him in and he'll figure it out.
Right.
I think that's a problematic model. And then you say, he's one who can listen. And I think the CROs that I think are the least effective are the ones that come in and all they do is tell.
Right.
And listening, I think, is an underappreciated skill.
Right.
Because at the end of the day, look, the business is the business. And all due respect, we've been making money long before you got here.
That's exactly right.
But it doesn't mean there isn't room for us to have a more structured, approach to risk as we grow and become more complex.
Right. And then he's able to fit into that organization where he's not seen as somebody trying to change the world and boil the ocean. He's coming in as now a partner who understands how we do business here, how we have been making money for all these years. But then he can bring becomes a trusted voice in the organization. Then his ideas, when he introduces some new ideas, could be something that needs to be changed or some new ways to think. They're not hit with, oh, no, we don't do it that way. It could be hit, well, maybe we need to listen.
Yeah.
Maybe you listen to us. Now we need to listen to you a little bit. So there's a trade-off there. So I think in this environment today, I think those are the attributes they have to be successful.
Well, and you sort of hit on a point earlier, which is this is really how do we take risk management and really weave it into just the fabric of our organization.
Yeah.
These are not bolt-on exercises. It really has to be a part of who we are, every day, inside and out.
Right.
Yeah. Let's talk about the regulatory environment a little bit. Banks have regulators, and as you mentioned earlier, every 4 years the winds tend to shift, and they are shifting right now. So a little bit of your perspective on how you see the winds blowing and where you see the regulatory environment looking over the next couple of years.
Well, I think it's in short, I think it's advantageous to many of the banks now with this market of deregulation. Things are opening up a little bit. If you think of the community banking market, I think the regulators are looking at this Taylor Act of 2025, looking to tailor their programs more to the risk profiles of the organizations, which I think makes sense. Everybody's not cookie cutter. So my perspective on that is it seems like it could be a breath of fresh air right now because people have different opinions on this. Some of it's overregulated, some of it's underregulated, but I think they're stepping back, and I think it was the deputy Fed chairman Michelle turned around and said the other day around how we want to look at things a little bit smarter. And it's not about getting stricter, it's about doing it a little differently based on the risk profiles of the organization. So I think from that perspective, I think the banks are going to benefit from some, especially the smaller ones. We're seeing some changes in the BSA Modernization Act. There's coming that looking more at what are we doing? How are we doing it? How are the organizations impacted by some of the regulatory processes that they have to go through, filing SARs, filing CTRs. That has always been a linchpin. Oh my God, I got to fill out this form. And what happens is bad information goes in, so they never get the right information at Treasury. And CTR is the same way. Now they're stepping back and saying, how do we make it easier for the people of the bank to give us the information we need so we can monitor more effectively? So I think that's a good shift in the market. I think you've looked at this CRA, you also have the CRA Act of, I think, 2023. It's going to be repealed, and they're looking to go back to some of the things that were prior to that. I think there's a benefit there. So what I'm thinking is I think it's a good thing. They're taking another look at how to do this better. Some people are thinking they're pulling it back. They're deregulating too much, where they're bringing in more risk into the environment. I think in some cases that could be true. But I think it's a good time to do this in the environment that we're living in. The other thing too is I'm seeing non-financial risk. I'm seeing they're taking the pedal off a little bit of the non-financial risks, operational credit, third-party business continuity. Give the banks a little bit more wiggle room to do what they need to do in that space, but keeping the feet to the pedal on credit risk,
right,
on liquidity risk, market interest rate, right? Because those factors are always going to be the ones that are going to hurt the bank the most and eventually hurt the customer. So I agree with that. I think that keep the pedal on that, get banks to do more stress testing. And I also think scenario analysis has to be done more, not just at that level to stress those, the capital buffer stress test and all those to make sure, hey, are we protected? But also the stress testing at the operational levels and start to think about how we stress on what could go wrong there. Because if you have enough operational failures at the bottom, it could affect the financial risks at the top. So I think my perspective is it's good. We're going in the right direction. We have to be cautious. But I think they're taking a good step in helping banks, some of these banks, maybe let them manage themselves to their risk profile, and the examination manuals should be in line with that.
Yeah, and just sort of on a similar theme, interrelating, with the supervisory, regulators. I mean, in my experience, I've seen two schools of thought. There are some institutions that take a line of tell them as little as possible, talk to them as little as possible. And there's a school of thought which is to be open and transparent. And look, it's your bank. You do what you want. But in my experience, the former tends to always end in tears. I've always followed. In fact, when I was a chief risk officer, and one of the first things I did is to say, look, I'm going to give you the good, the bad, and the ugly. I'm going to be very transparent.
Yeah.
I found it worked very well because we really came to respect each other and have good dialogue. And if I'd say, look, I think this is a problem, I think this is risk, here's what we're going to do about it. I think we established a very good rapport. But do you agree? And,
Yeah.
and do you find that your clients are the most successful when they're very transparent with their supervisors?
I think so too. And when I was in banking for 17 years in New York City, one of the things that we did, we always had an open dialogue with the regulators all the time. Whenever we had a blip internally, we always called the regulatory agencies and got them involved with it right away. That took away the aha moment when they walked in the door and they wondered, why didn't you call us? So I think that relationship I've lived with as a mantra from when I was a practitioner years ago. And that's something that I tell my clients all the time, to be more proactive with the regulators, be transparent, let them know. It happened. It's going to be out there. So if it's a bad story, it's a bad story. But the idea is how you're dealing with it,
Yeah.
and how you're going to work operationally, technologically, maybe reputationally in the market, and how you're going to deal with that. And they'll be respectful of that. They'll understand that because they realize things happen. And we just need to be forward thinking. And I think that would alleviate some MRAs and some of the consent orders going forward if people would just look at that and do more. I think the banks that do a good job at it, and I think banks that could do a better job at it.
Well, I mean, look, at the end of the day, they want you to succeed.
Right.
But at the same time, they want to make sure you're, doing the right things.
Right.
All right, we're going to take a very quick break for a quick commercial message, and we'll be right back after this.
One of the most important questions you can ask about your enterprise risk management program is it helping you make better business decisions? Or is it simply taking up a lot of people's time without creating any value? Is it helping you gain a better understanding of your business? Or merely documenting what you already know? The tools and resources available from ERM Advantage are built specifically to help any organization get the most out of their risk management programs. We have the largest library of free content covering proven best practices in enterprise and operational risk management. We have developed industry-leading tools and templates for every aspect of the program, including risk appetite, risk assessments, risk monitoring and reporting, and so much more. All available at a fraction of the cost of developing these tools from scratch. We are ready to assist you with program development or enhancements, board or leadership training, or reviews of existing programs. Contact us today to see what best-of-breed risk management can look like in your organization.
All right, welcome back. We're going to continue my discussion here with my colleague, Allan Cuttle. And we've been talking about just general risk management and the industry. And I want to talk about area near and dear to your heart. And when it comes to, GRC systems, governance, risk, and compliance, also known as integrated risk management, ERM, Allan is my go-to subject matter expert. He's forgotten more about GRC solutions than I know. So I know this is an area that over the years we've seen, again, the good, the bad, and the ugly. I've said for years, I think the perfect system hasn't been written, but who knows? But I want to kind of talk about your experience, observations, some best practices. So let's just start with, again, there's a lot of solutions out there ranging from very entry-level, simple to mid-market to the big battleships. Yeah. We're not going to name names today, so don't worry there. But, what do you see as really differentiating characteristics in some of the best solutions?
That's a good question. So what are some of the differentiating characteristics? Well, I'd say one is you've got some solutions that are going to have everything out of the box. And I think that's a good way to start, because these solutions have everything that a client may need, less configuration, less customization, and that gives a leg up for a lot of those clients using those solutions. So I think that's important. I think agility is another thing that is out there that's important for these systems. I think we're seeing a shift right now. Years ago, we didn't have a lot of low-code, no-code providers that we could really put our finger on that were truly low-code, no-code. And I think we're seeing a change in that environment. And that's interesting because agility is key today, not just in risk and not just in business, but also with these solutions, because they have to adapt to these institutions as well. So the agility factor is key.
And you mentioned agility, and I think that's really, really a good point.
Yep.
And I've observed some systems, and in part, I want to unpack what that means, because people listening may say, well, what do you mean by agility? I've seen some solutions that are somewhat rigid. Our system has to do it this way.
Right.
And it seems like there's more of a trend around we will be able to configure our application, not customize,
Exactly.
but configure application to be able to work the way you. So that would that be an example of some of that agility that you think is important?
I think so. It's not just configuring it day one, but it's also going to be the reacting to changes going forward, updating the hierarchies. Because banks and credit unions change all the time. So the ability to look at that hierarchy and say, okay, now we need to change. We just acquired another institution. How do we incorporate that institution into the GRC? And how do we change the hierarchies? How do we change the libraries, the taxonomy? So that's going to be key in there too. And I think that gets back to something else too, is the federated data model. It's the data. Also, how does these systems use the data it's given? Because these systems are empty shells. When you look at good attributes of systems, it's also about the ability to absorb that data and create one-to-one relationships, one-to-many, many-to-many relationships overall. And you've got to incorporate that in there. Big reason. You also have the reg change applications coming in now. You have markets changing regulatorily. Things are going to come in. They're going to impact your policies and procedures, your risks, your controls. Having that federated data model is going to enable you to make those changes, make those connection points, and use that as a basis for a lot of your reporting. The other thing I'd say too is integrating with systems. So other systems, ERP systems, different types of complaint management systems that the organizations may have. As you and I both know, that you don't need to have one GRC that can operate everything in the organization. So we've got things like IT, business continuity, third-party risk. We don't need that one platform to work all those areas, but we have to be able to integrate with those systems to bring those data points into the GRC so that you can affect good reporting. You can understand, well, what's the impact on my vendors? Operational resiliency is a great example about this. It looks at operational risk, it looks at business continuity, looks at vendor, looks at cyber. And a lot of times, if you have a solution that just does risk management, compliance, reg change, and policy, they sit outside that. So the integration points to those systems are going to be key. And I'll say this, in the larger institutions, and you know this going back years, we've talked about this many times, these larger money center banks have never just had one solution. They're just too big.
Yeah.
There's different elements within different organizations, from retail banking to commercial banking, mortgage lending, leasing, capital markets. They're going to use different solutions. And the ability for those solutions to talk to each other in the organization and share data so that you can pull an overall report. And that's where AI is going to come in really helpful these days.
Yeah.
AI can sit on top of all these different systems and be able to integrate the data up. So the integration capabilities of these systems are going to be really, really key.
Yeah, and I agree. And one last point on agility. Maybe this is just a pet peeve.
Mm-hmm.
I'm willing to own that.
I'll have some comments on it too. Yeah.
If is part of that also, our business changed, we now need this element in our GRC, whether the vendor is saying, no problem, that can be configured to do that, versus, oh, we'll build that for you and that'll be a year and $1 million.
No, agility means something very different today. And that's going to be not a challenge, but I think where the larger big box solutions are going to have to adapt to is that automations, triggers, workflows takes days. Actually, some of them will take hours and days to get it done, not days and weeks and months. And the cost to doing that is going to be a lot less, if not insignificant, to doing that. So I think that agility factor is going to be tremendous. So it's not just about the comment you made about just can it adapt to the changes, but the time it takes to affect those changes are going to be a lot less. And you could either do it yourself, or you can work with a system integrator or a third party to help you do those changes. But it's going to include a lot lower cost. And the last thing I'll mention to this is there's been a set of organizations that have been precluded from buying GRC solutions because of the expense, and those are the smaller banks. Whereas now with some of the low-code, no-code features, and I think some of the larger solutions are coming around this as well, is that they're offering a model that fits their organizations economically and operationally, so they can actually bring in technology into a $500 million, $1 billion bank, where you and I knew before that may not be possible economically, but they can do it. And they can start to use technology early on in their programs if they're mature enough, and then they don't have to wait to they're maybe $3.5, $5 billion with the other critical mass to support it.
Yeah, that's a really, really good point. And we've seen many times where a smaller institution doesn't really have a framework or much of a program, and they start thinking about, well, when we bring in a technology and that will solve all our problems. Right. And
silver bullet.
I've never seen that work out. So maybe you could talk a little bit about in the evolution of a program, how to think about when might be the right time to start thinking about an automation solution?
So that's a great question, and that's something I think about all the time, because you'll have to look at it every time I speak to a client. I ask them, what does your program look like? Where are you in your evolution of your program? Do you have risk appetite? Do you have governance? Do you have training? Do you have risk assessments? I try to understand where they are in that continuum. That gives me a better lenses to know is whether they're ready for technology. Because I'll be honest with you, I've walked away from clients in a way that said they needed technology to say, I don't think you're quite ready yet. I'd rather work with you to help you nip up your framework a little bit more, tighten it up. We can help you with your risk assessments, get a methodology in place, then look at technology. And I think there's a maturity model that I've used in the past that starts out with initial, and an initial framework is one where it's just ad hoc, bare bones type of processes in place around managing risk, here and there, nothing consistent. There's no templates in place. Then you get a little bit up more to defined, and that's where you're starting to define some of your framework elements. Maybe you have some risk appetite ideas. You've got a basic risk assessment template. Maybe you got one or two KRIs that you have, some basic reporting, and then you get to a point of where you're managing it. Now you're managing risk. That at that managed level, that's where you got your risk assessments, and they're being pushed out by second line down to first line, or you've got RCSAs at the first line. You've got some KRIs, some parent-child KRIs even possibly, where we're managing some of the key risks and areas and monitoring those through KRIs. And then you've got a risk appetite statement that you've facilitated with the C-suite of the board. That's when you start to manage and you're getting some good reporting. At that level, I think that's the level that you need to have technology. Because if you look at your program and you say, you know what, it's mature, but I can't handle the volume. I've got a lot of risk assessments across all these business lines. I've got rate changes, a good example. We got too many rate changes coming in. How do we manage that manually? We're going to miss something.
Yeah.
So when you look at this and say, I need to do this because I'm afraid of missing something in my program or not reporting on something, where I need technology to sort of ring fence it and give me some better analysis so I can better manage risk. That's the point where you need to say, I'm at a point where I need risk. And then the optimized level, that's the top of the house. So you've got to find that optimized. That's where you've got everything integrated. It's integrated risk management. You're using all the spines within the system, like your GRC libraries, process libraries, your risk libraries, your control libraries, your third parties, your policies, your procedures, and all of that is connected. At that point, you're probably going to have technology and maybe on your second or third systems at that point.
And, as people think about technology, a pain point that I've seen is jumping into vendor demos before you've really thought through your requirements. So maybe you could talk a bit about the significance of defining your requirements before you begin the process of doing vendor reviews.
I'm a tremendous proponent of that. I mean, I think you need a blueprint. You need a GRC blueprint in order to know where you're going. And I'd actually back up one from that. I would say you need to define what does success look like for my organization from a GRC perspective. Before you're even sitting down and doing your requirements, which are the details of how these systems are going to work, you need to understand what does success look like for my institution. And you want to understand who's going to be using the system, whether it's going to be multiple systems or not, who are the stakeholders we need to engage with, and what are the outcomes we're looking for. Is it reporting? Is it KRIs? Is it risk assessments? Is it reg change? Understanding all of that. Once you have laid out that blueprint at a high level, what does success mean for me? And working backwards a little bit from understanding what are the outputs that you need and working back. When you start to work back, now you can uncover some of those business requirements because you know what success looks like. You know the outcomes that you're looking for, and now you can work backwards to develop the business requirements. Because if you don't know where you want to get to, you never know how to get there in the first place. So at the end of the day, you need to start, I sort of say, work backwards on this. And that turns out very well, because then you can sit down with both first line and second line, and potentially third line if you're bringing in audit, to work out all the different requirements at all those different levels. And I think one of the mistakes that some folks make is that a lot of this is done in second line of defense sometimes. And first line always doesn't have a seat at the table. Where I've seen the most success on this and the business requirements gathering is having all three lines together. Because no matter what you do, even if audit's not involved, they're going to be dependent on some of that information. The risk libraries, that central spine, that is the one single source of truth which everybody can leverage. But your point's well taken. A good set of business requirements and how we're going to use the system for risk assessments and a level of detail that makes sense. And maybe this will get to your next question, but once you do, having that business requirements document done, that's going to be a living and breathing element similar to risk appetite and similar to some of the ERM programs, because That'll be the start of the BRD, business requirements document. But even as you implement a solution and upgrade the solution later on, that BRD changes,
Yeah.
it morphs. And that's the one central document you can go back to at any time to say, this is what we used to build out our initial requirements and focused on what solution we should be buying,
Yeah.
because that'll tell us which one that has the elements that we need. But also that'll be the one to memorialize what the system looks like, and then all any changes that have come up between the time we implemented it and current date.
I mean, your point about if we don't have success defined, we're kind of dead at the starting line.
Right.
And the scenarios I've seen go the worst is they say, well, we'll start with vendor demos and see what their system can do.
Never.
So, okay, let's assume that, you went through a process, you defined your requirements, and you found, what you think is the right solution for you. You've done a lot of system implementations with a variety of solutions. Maybe some sort of best practice do's and don'ts as you're going to implement a new solution.
Yeah. And I'll step back one step further on the vendor demos you bring up. I think it's very good. I always use the point, trust but verify. One of the things you get in trouble with, and this affects the implementation, when you're in the middle of implementation and you've gone through the sales process, and all of a sudden you get to a point where the client says, well, I saw this on the demo. And the sales representative on the demo said I could have this such a way. That's a lesson learned on an implementation, because you want to go back, and when you do a demo with a client and there's certain use cases that you've given in an RFP, so use as an example, and the client says, oh, yes, we can do that for you. And we have that. And they show you something of that, which is fine. As a client, as a buyer, there's no reason why you just can't say, hey, can you just hold on a second? Can you show me how this actually works? Can we go a little deeper on this so I can understand it? And it's a good thing, because the client then realizes that the vendor's interested in being successful for them, and then unpacking that requirement a little bit more so they can see exactly what's there. Now, when it comes to implementation, that makes it a lot easier, because then we're working with the client to configure the solution to their framework.
Yeah.
Not so much customizing it to work in a specific way on a specific requirement that was a little bit in the gray area when they did the demo. So I just wanted to bring that up before I get into that.
Yeah.
But you mentioned what makes a good implementation. I think there's a couple of things. One is good project management. That's number one. One is we will always want to stay on time and on budget and deliver exactly what we said we would deliver. I think that is very, very important, because a lot of times there are cost overruns with these projects. And one of the things I've kept my teams on is we always stay in budget and we always stay on time. That's a big thing. The next thing is over communicate with the clients and over communicate them on status, where we are with the milestones, how are things going. The other thing too is to make sure that we have really strong client workshops, because there's a few things on this. These systems are empty shells. So what makes for a really good implementation is getting that foundation set first.
Yeah.
And what I mean by the foundation is understanding what the organizational hierarchy looks like that we're going to be putting in the solution. How does the organization want to be structured inside the system? Some of these systems have multidimensional org structures. Some of them have a single spine. We want to replicate that in the solution, because that's going to help us use it going forward.
Yeah.
Then from that, we want to bring in our products, things that are normally known to clients. Then you want to bring in your processes, and you bring that in. Now, that's interesting about process. I'm not going to go off subject here, but I want to bring up that more times than not, banks and credit unions continue to refine their processes. That's one thing in a library structure they don't always have. So by going to that, we help them not only put it in the system, but we also help them rethink about their processes and do that. Then bring your risks and your controls in, all the data points that need to be connected. In addition to that, you have third parties, and you have your compliance requirements, and you have your regulations, regulatory bodies. Setting up that foundation is key. And that the most time I think we spend on it is on that foundation, because once we get the data in the solution and we get it properly mapped, the configuration of the applications themselves around workflow, around approvals, around the list of values that they may need, how they categorize root cause, how do they categorize, their scoring for risk assessments, how do they score their controls? They have a framework. We can bring that into solution. We just have to configure it. Getting the foundation right is key. From there, we want to work on configuring the solution and making it work for them. And then also at that point, we're going to test. And one of the key parts, and I think we've seen this many times, we as implementers would test the solution. before the client even gets a shot at it, because we want to make sure that it reflects everything the client wanted. Because what makes a successful implementation is the client going in and doing UAT testing and saying, this works fine. Maybe there's one or two items that we have to maybe refine, but it's not a minefield of information, not a minefield. And they appreciate that because they realize, wow, we listened to you. We understood it. We put it in place. Yes, there'll be one or two items we may have to adjust, but we can do that. And then we immediately fix it, communicate that back to the client, provide them the ability to test with really good test scripts, give them the test scripts that they need to use so they can test the system, make sure it's working the way they need to, and then giving them training. And then at that training, you're pretty much ready to go live. And I think those are pretty much the basic elements of that. But I think it's good project management, over communicating, being responsive, and also making sure we stay on time and on target, because they promised people at the organization who paid that bill to buy the system that they need to get it in at a certain time. So we want to make sure they keep their promise. And I think that gives the implementer has credibility, but it also is a success factor for the folks in the organization doing the supporting that.
Well, it goes back to a point you made earlier, and obviously you are an implementation partner. You
Right.
work with a variety of solutions to implement within institutions, and so what I heard there is a recurring theme of communication.
Yes.
And if you're an institution and you're contemplating bringing a solution in and using an implementation partner,
Right.
You should gauge a lot by your discussions with them and how well they're communicating.
Right.
If they're not communicating in the proposal phase,
Right.
this isn't going to go well.
Correct.
And it's a really good sort of a barometer of what this is going to go like, is how they communicate and whether they feel like you're always in charge,
Yes.
and not them.
Right. And we understand what good looks like, and they should trust us, because we do have clients that do hire us, and they have an idea of what good looks, and they want us to follow that fine. And we have clients that we can give advisory services to as we're doing the implementation. And it's always a mix of that, but also communicating back and forth. And then they're like, wow, I never thought of it that way. And I think one of the other interesting parts about it is, and I think something that we bring to the table, and that may be a little different than some other integrators, we bring domain expertise to the table. So we not only understand GRC solutions, and having been in the industry for 30 years, we've seen where things have gone wrong over the years and the mistakes we made 20 years ago. Some of those mistakes, but some we're still making them today. But I think we know how to help them from the domain expertise. So we see things in the framework that we can kind of talk to them about. Hey, you may want to look at it a little different way. And they're like, wow, I never thought of that.
Yeah.
And it really makes the system jump for them.
Yeah.
The last thing I'll say about implementations is key to getting it right is the reporting. One of the linchpins in the systems for years, as you know, you and I have had this discussion as well, reporting has not been the strong suit of a lot of these systems. Now, a lot of them use third-party solutions like Power BI and Tableau, but we're seeing a different shift in the market now with AI, and I think AI is going to bring a different switch to this. We're going to be able to get better reporting. We're going to be able to take data that's in the solution and compare it to other data tables in this system to get us more predictive analysis on things that will give us better risk management results. So I think going forward, I think reporting is a big thing, but now we may have a few more tools in the toolbox to make that a reality and give the clients really good reporting going forward.
Well, it makes sense. I mean, there's so much effort going into spinning up one of these systems and getting data into it. If we're not getting good data out, kind of what's the point? Right. And it's funny is as you were talking about some of those implementation points, I think back in a prior life, we had a client we worked on together that, was a decent sized financial institution that put a GRC solution in place, and we came in in a very awkward place. They had not been supported well by their prior partner, and I know we met with them, and I've never really seen fire in somebody's eyes. They were ready to throw us out the window, and the solution as well. And we said, well, you tell you what, why don't you just give us a shot, because they weren't us. So maybe you could, we're not naming names, but maybe you could talk a bit about you walked into an environment where they were literally on their last breath with the solution, and you've now turned that around to a client that 10 years plus later is still a really good client. How did you do that?
It was interesting. It was very interesting. And the client was mad, and they were angry about this because they had bought something that they thought was suited for their organization. It was a little bit not what they thought. And not only that, so the system wasn't fit for purpose for them, but then there were some bugs in the system. There was some unresponsiveness from the vendors. And there wasn't anybody to hold their hand to say, help us through this. We need to get through this. So I think what we did was, I look at this as a good GRC support exercise, not only implementation because the system had been implemented, but it was after the implementation that this really happened. So our support kicked in and we offered them our support model, which was, listen, we will work with you and the vendor directly. We will contextualize what the problems are so we understand it, not only from a GRC perspective, from a domain expertise, and adequately communicate that back to the client, but to the vendor, so we can get the fixes that we need in place, get them on time. We'll be the ones to go behind it and test it before you get it. So we wanted to take all the burden off the client. And that's the key part. We wanted to take all the burden. And we were able to successfully lift that burden from the client's hands. They could get back to using the solution on a day-to-day basis. In the meantime, we're fixing the bugs, we're fixing the inadequacies in the solution with the vendor, we're over communicating with them, so we're making them feel like they're the top priority, which they are, and we're able to then put a process in place going forward where this would just be normal business cadence, where we would support the solution. So we ended up taking over level 1 and level 2 support for the vendor, and we were able to work with the vendor on any issues and bugs, track tickets, follow up on the tickets, communicate with the client, give them what they needed on time and on budget. And about after 6 months, they saw the value in GRC, really good GRC support. Not only did it right the ship and keep them from having problems and enable them to use the solution very effectively, but it also gave us a client now for the past 11 years, and we've been working with them to bring in other solutions and other services as well.
And what's really interesting is that what you're saying is it's not just about the technology.
No.
In fact, more so, it was about the support model
100%.
built around it.
Yes, and I think that's what's lost sometimes on the implementations. People think they're going to buy a solution, they're going to implement it, and all's right in the world, which it can be. It can be in some cases. But the key part of it is when it's done, now what do we do with it? Now, and you want to be able to take that journey with the client, because it's kind of a fun journey to take, whether it be for 3 months and 6 months until they get their sea legs. In some cases, we've taken it for 6, 7, 8, 9, 10 years with the client. But it's that part after the implementation which is key, because now that you're trained on it, you want to use it. And there are some times where we see clients not use it for 6 months, and all of a sudden they come back and they're like, well, we need refresher training and we need to get up to speed on this. So what we try to do is keep that momentum going. Get the clients to use the system the way it was intended, work with them to start doing the assessments, doing the risk appetite, issues and actions, loss data collection, whatever it would be, managing vendors, be it BCM, business continuity, business impact analysis, have them use that. What that does is that starts to show the value of the solution in the organization. And it actually helps the organization gain buy-in within the organization for people to say, why did we buy this? Oh, I now see the value in it. Mm-hmm. And it increases adoption.
Yeah.
And what that does is it gets more people to use the solution. And not only that, if there are other applications, they say, hey, this makes sense. Why don't we buy a few more applications to even further automate our process? And I think that's a key thing. And the last thing I'll say on this too is at that point, you really get to see the first line and second line use the solution. And hopefully the answer is, wow, I like to use it.
Yeah.
I want to use the solution, because that's the whole idea why you made the investment.
That's funny, because a whole lot of people listening or watching it right now just went, oh God, if we only could get our people to say, I want to use that solution.
Right. and that goes back to my other chat before about business requirements and also bringing in first line of defense.
Yeah.
Because first line lives and dies with these systems all the time. They're going to be the ones that are going to use it. And if they're part of the process to buy it, then when the implementation goes in and they're starting to use it, they're seeing the fruits of their labor, saying, the requirements that I put in here are here.
Yeah.
And I can actually use this day to day. That actually in turn starts to help build culture, whether it be compliance and risk, because once you're using the system, it kind of sits on your desktop.
Yeah. And
And then you're able to go in, your processes change, risk change, control change. You're updating the solution directly, and that's adding to a better foundation in the system. And then your culture is getting a little stronger.
I want to go back to earlier point to sort of pull this together. You talked about AI. Maybe you could just talk a little bit about what you see on the horizon, whether it's new AI capabilities or any other sort of future features that you'd like to see in some of these solutions.
Yeah, I think when it comes to AI, I think the jury's still on how this is all going to work and come together. We hear a lot about AI in the industry, but what I'm seeing, I actually like quite a bit. I've seen a few solutions. Went to the recent ABA conference and got a chance to sit with a few of the vendors and get some demos. So I'm very excited about the of what's to come. Something I said earlier, I think it'll be a good conduit to pull data in the organization from the various solutions that they may be running. So we have the ability to gather better information and bring it into the model, and then we're able to use that for better reporting. That's number one. Number two, from that reporting, we can get more predictive analysis out of it. So we can be more proactive on how we're managing risk. Because with any of these GRC solutions, you've got lost data, you've got issues and actions, you've got results of risk assessments, you got your risk appetite. But AI can look at all that information and start to paint a story for you. So I think predictive analysis is going to be key for us going forward. I think the other part of this too is on the regulatory front. Now, in the regulatory front, it's kind of interesting because we've got providers out there, third-party providers that have been out there for a long time providing regulatory alert data, which is great. And I think, and that's on that vein, is that regulatory alert data comes in, organizations have to say, well, is it applicable for me and what's my impact? And then to decide upon using that AI to figure out where the impacts lie. And the impacts could lie in need to update your policies and procedures, update your controls, update your risks. Now, what that leads me to is AI can also help you create better policies and procedures and better format. Think about policies that need to be written in a way where it identifies the compliance requirements and identifies the controls that are in your libraries and identify those risks. I think one of the hardest things to do today without AI is to say, okay, the environment's changing, our processes change. Now, what do I need to update in my risk and my GRC system? That's going to be by memory or by your business requirements document. But with AI, reading where all these things could sit, it could easily say, hey, if I'm changing this regulation, well, it impacts this process, it impacts this control, it impacts this risk. It also impacts a process because it's run by this external vendor. And you know all the data points. So I think what AI is going to do is going to paint that picture for us and point us in the right direction of things that need to be updated. So I think AI in the GRC space, well used, can be a game changer. The other thing I'll say on this too is when you go in and you put issues and actions into a GRC or you're doing work, if that model AI is looking at all these things, it'll know where you've had other issues, other problems, other root causes, and it'll start to do a good job on root cause analysis, repeat issues, things that we saw before, and it kind of can help you identify a lot of good systemic themes, thus going back to the more predictive analysis of where the risk event could happen because we're seeing chinks in the armor, and the AI can sort of uncover that for us.
I was going to say, it seems like there's kind of a brass ring here. Are GRC solutions going to, continue to evolve to the point where they're actually providing predictive information?
That's where we have to get to, because a lot of CROs that'll ask me today, they'll say, my team's very reactive. I've had that from a couple of first line people tell me, my team's very reactive to this, but how do we get them more proactive? With and without technology, how do we get them more proactive? Yeah. So this is something that's facing us right now, and I think AI can help solve a lot of those problems.
Interesting. Again, I want to thank my friend and colleague, Allan Cuttle, for joining us today. I find this topic around, both risk interesting, obviously, but around, GRC that, I think we've seen potential for a long time, but I don't know we fully achieved that potential. So thanks for coming in and talking today.
Thanks, Eric. Appreciate it. And thanks for having me. It's a great topic. And I'm anxious to see what happens over the next 5 years in this space as AI gets a little bit more mature and gets integrated into the GRC solutions. But not only that, how that can help better manage risk and compliance in organizations. So
yeah, your mouth to God's ears.
Yeah.
All right. Thanks for listening.
The ERM Advantage podcast is recorded at Lightshed Studios, Philadelphia, Pennsylvania. Copyright 2026 ERM Advantage, LLC. All rights reserved. To inquire about appearing on the podcast, please contact us at ermadvantage@gmail.com.